Everything your parents told you about money is quietly destroying your financial future. Save more, spend less. Put it in the bank. That is the advice. That has always been the advice. And for millions of Americans following it faithfully every single month, it is the reason they are getting poorer in slow motion. And they have absolutely no idea it is happening. Here is the number that should bother you. The average savings account at a major U.S. bank right now pays 0.01%, APY. Not a typo, 0.01%. You park $10,000 at Chase or Bank of America, and after a full year of saving, they hand you back $1. $1. Meanwhile, inflation in March 2026 is running at 3.3%. So your money just lost $330 in real purchasing power while your bank congratulated you on earning a single dollar. You did not save your way forward. You saved your way backward. The economy has changed. The rules have changed. But the advice most people are getting, the advice being passed down at kitchen tables and shouted from financial influencers, has not changed at all. And that gap between old advice and new reality is costing the average American thousands of dollars every single year. So let us talk about what is actually happening to your money, why your brain is designed to miss it, and what people who are actually building wealth are doing instead. Start with a number almost nobody talks about. Cumulative inflation from 2021 through 2026, just 5 years, sits at approximately 21.86%. Something that cost you $100 5 years ago costs around $122 today. Not a small rounding error. That is the largest 5-year erosion of real dollar value in 40 years. Your grandparents saw something like this in the late 1970s and early 1980s. Most people alive today have never had to think about money this way. And yet right now, Americans are holding roughly $10.6 trillion in savings and checkable deposits. $10.6 trillion, the overwhelming majority of it sitting in accounts earning somewhere between 0.01% and 0.39%. The FDIC national average for savings accounts as of late 2025 was 0.39%. Most big bank customers are not even hitting that. They are down near zero. That gap between what inflation is doing to your money and what your bank is paying you is your real annual loss. For most Americans, that number runs between 2.3% and 3.3% per year, every year, compounding quietly in the background while the balance in the app looks fine. Here is where the psychology gets dark. In 1928, an economist named Irving Fisher identified something he called money illusion. John Maynard Keynes picked it up and pushed the concept further. The basic idea is this: human beings are wired to think about money in the numbers they can see, the nominal figures, not in what those numbers actually buy. We see the balance. We do not feel the purchasing power. Think about this. You had $500 in savings back in the year 2000. That $500 could have bought you roughly 400 cups of coffee. That same $500 bill sitting in a drawer today or earning almost nothing in a savings account buys you about 111 cups of coffee. The number on the bill has not changed. The number in your app has not changed. But the actual value, gone. More than 70% of it, gone. Or think about your last raise at work. If your employer gave you a 2% pay increase while inflation was running at 3%, you felt like you got something. You probably said thank you. You might have gone out to dinner. But in real terms, in what your paycheck can actually purchase, you took a pay cut. The number went up, the power went down. That is money illusion working inside your own life, probably without you ever noticing. Saving feels like progress even when it is not, because the number goes up. Month after month you watch the balance climb, and your brain registers that as winning. The invisible tax collected by inflation does not show up on any statement. No line item reads, inflation fee charged this month, $27.50. It just happens. Quietly. Continuously. And after 5 or 10 years you look up and wonder why it feels like you are running in place. Now let us put real numbers to this because abstractions are easy to ignore and dollars are not. You have $10,000. You put it in a standard savings account at the national average rate, 0.39% APY. After 1 year, you have earned $39. Nice. Except inflation at 2.7%, the 2025 annual rate, Just strip $270 of purchasing power from that same $10,000. Your net real loss for the year is $231. You followed the rules. You saved your money. You did what responsible adults are supposed to do, and you ended the year $231 poorer in terms of what that money can actually buy. Stretch that out 10 years and it gets significantly worse. That $10,000 in a standard savings account, adjusted for real purchasing power, shrinks to approximately $8,200 a decade from now. You did not grow your money. You watched $1,800 disappear. Now put that same $10,000 into the S&P 500. The 10-year average annual return on the S&P 500 is approximately 10%. After 10 years, that $10,000 grows to somewhere between $25,900 and $27,600 depending on timing. Not $8,200, nearly $27,000. The difference between those two outcomes, standard savings versus index investing, is roughly $19,000. On a single $10,000 decision, made once. And if you want to zoom out further, $1 invested in the S&P 500 in 1990 is worth approximately $39.32 in nominal terms today. Even after adjusting for inflation, that dollar holds about $14.56 in real purchasing power. A savings account from 1990 holding that same dollar never kept up. Not even close. The people who are ahead financially right now are not better earners in most cases. They made a different decision about where their money lives. So what is the right move? Break it down into 3 categories because they are not all created equal, and treating them the same is another mistake most people make. The standard savings account at a big bank is, for nearly every purpose, the wrong place to store meaningful money. 0.01% is not a yield. It is a fee paid in slow motion. The only reason to use it is for a checking account linked to your debit card for daily spending. Full stop. Any dollar sitting idle in a Chase or Wells Fargo savings account earning 0.01% is a dollar working against you. High-yield savings accounts are better, meaningfully better, but they are not a wealth-building tool. As of April 2026, the top HISA rates sit around 4.20% to 5.00%. Varo Money is offering up to 5.00%. Bank rates top picks are around 4.21%. Compared to 0.01%, that sounds good, and it is. But here is the catch. With inflation at 3.3% right now, a 4.20% HISA barely keeps you ahead. You are earning maybe 0.9% in real purchasing power. Not losing, but not growing either. There is also a structural problem. The Fed cut interest rates 3 times in late 2025. HISA rates peaked at 5.25% or higher back in 2023 and 2024, and they have been sliding ever since. The yield you lock in today is not permanent. When rates fall further, and historically they do, your 4% account might become a 2.5% account, and a 2.5% HISA against 3.3% inflation is a loss again. You are always one Fed meeting away from the math flipping on you. HISAs have one legitimate purpose, and it is a real one. Your emergency fund. 3 to 6 months of living expenses. Liquid. Safe. Not subject to market swings. That money belongs in a high-yield savings account. Every dollar beyond that, the money you are not going to need in the next 6 months, needs to work harder. Now, 45% of Americans keep their money in lower-rate local banks specifically for branch access. That loyalty carries a real cost. The convenience of a nearby branch is worth something. It is not worth losing 3% of your savings to inflation every year. Index funds are where most people's situation actually shifts. The S&P 500 is not a complex instrument. It is 500 of the largest publicly traded American companies: Apple, Microsoft, Amazon, Berkshire Hathaway, Nvidia, all in one position. When you buy an S&P 500 index fund, you are not betting on any single company. You are betting on American corporate earnings as a whole. And over any rolling 20-year period in modern U.S. market history, that bet has paid off, every single time. VOO, SPY, IVV. These are the tickers. They track the same index. They charge almost nothing in fees. VOO sits at 0.03% annually. And over the long run, they have returned an average of about 10% per year. That is not guaranteed for any single year. Markets go up and down. 2022 was painful. But zoom out and the trend is undeniable. The S&P 500 posted positive results in roughly 75% of all calendar years since 1928. If you want broader exposure, VTI, the Vanguard Total Market ETF, covers the entire U.S. stock market, not just the top 500. More companies, similar historical returns, nearly identical fees. The structure that works looks like this: 3 to 6 months of expenses in a high-yield savings account. That is your emergency fund, and it does not move. Everything beyond that, money you will not need for at least 5 years, goes into a low-cost index fund, inside a tax-advantaged account if possible. A Roth IRA, a 401k, or a brokerage account in that priority order. You contribute consistently. You do not try to time the market. You let compounding run. The math on consistent investing is almost unfair compared to consistent saving. Someone who puts $500 a month into an S&P 500 index fund starting at age 25, running to age 65, at the historical 10% average, ends up with roughly $2.6 million. Someone who puts that same $500 a month into a savings account at 0.39% for the same 40 years ends up with around $252,000. Same amount deposited, same time period. The difference is $2.35 million on one decision made early enough to matter. None of this is about ignoring risk. Markets fall. The S&P 500 dropped nearly 20% in 2022. Anyone who panicked and sold locked in that loss, but anyone who stayed invested watched it fully recover and push to new highs within 18 months. Time in the market beats timing the market. Every study, every data set, every time horizon confirms it. The real problem is not that people do not know investing exists. People treat saving and investing as interchangeable. They are not. Saving is preservation. Investing is growth. Preservation matters for your emergency fund, for short-term goals. But preservation without growth is a slow bleed when inflation is running at 3.3% and your bank is offering you $1 on 10,000. Here is the uncomfortable truth most financial institutions will never say out loud. The big banks are not designed to make you wealthy. They are designed to make themselves wealthy using your deposits. They borrow your money at 0.01%, lend it out at 7% to 9% on mortgages and car loans, and keep the spread. The system is built so that your inaction is their profit. Every month you leave $20,000 in a Chase savings account earning 0.01%. Chase turns a healthy margin on your money while handing you back $2 at the end of the year. Knowing that, really knowing it, not just hearing it once, should make it uncomfortable to do nothing. The median American holds $8,000 across all their savings accounts. That is the person this video is for. Not someone with a $500,000 portfolio already running tax loss harvesting. The person with $8,000 who is doing exactly what they were told, watching the balance climb by a few dollars a month and wondering why financial progress still feels so far away. That gap is not an income problem in most cases. It is a placement problem. The money exists. It is just sitting in the wrong place. The 3-step fix is simpler than most people expect. First, keep 3 to 6 months of expenses in the best high-yield savings account you can find, 4% or higher right now. Second, open a Roth IRA or brokerage account if you do not have one. Most take less than 15 minutes online. Third, start moving excess savings into a low-cost S&P 500 index fund. You do not need to move everything at once. Start with whatever feels manageable. But start. The $10,000 sitting in a big bank savings account earning 0.01% is not safe. Safe is a feeling. What is actually happening is a guaranteed slow inflation-adjusted loss of real purchasing power every single year you leave it there. The risk you think you are avoiding by not investing is already happening inside the account you believe is protecting you. Saving money used to be enough. In the 1960s and 1970s, savings accounts paid 5% to 7% because regulations required it. That world is gone. The new game requires more than discipline. It requires positioning. And the people who figure that out in their 30s rather than their 50s are the ones who end up with options. So here's what I want you to sit with. Right now, somewhere between $10.6 trillion and $17.7 trillion in American savings is sitting in accounts earning less than inflation. Not a financial system protecting its people. A financial system quietly, legally, and continuously extracting from them. And the only way out is to understand the game well enough to stop playing by rules that were never designed to benefit you. Tell me in the comments, what is your current savings setup? Are you in a high-yield account, still in a big bank, or already investing? I want to know where most people actually are, because the answer might surprise you. If this opened your eyes to something your bank never told you, hit the like button and share it with someone you know who is still parking money at 0.01%, because they need to see this. And subscribe right now, because next week we are getting into exactly which accounts to open, in which order, and the specific numbers that determine how much of your paycheck should be invested versus kept liquid. That one will reshape how you think about every dollar you earn. You have been doing what you were told. Now it is time to do what actually works.